Yeah, I think a big thing that we do on the CMT Association, I'm a board member there, is outreach, right? So we partner with a lot of academic institutions to help them realize that this can be a part of the curriculum, allowing students to learn about the market cycles, but also allowing them a particular edge in creating their own investment process. Also understanding that there is a time and a place for trading versus investing. Those are very basic skills, but it's also very relatable. So we do a lot of that within the CMT group.
In fact, you provided us with a full screen, which I believe we can bring up, which talks about these cycles. And again, we were going through some of the cycles with Joseph, but walk me through what you created for us with this image: the early cycle, the mid cycle, late cycle, and recession.
Yeah, so a lot of people, utilize the business cycle to think about investment positioning. So I use this same concept that we use at Fidelity to understand business cycles and different asset classes work during different times. And as you know, the early cycle environment is when we're coming out of a recession, then when there was peak fear, but there's a lot of opportunity to realize the first initial market gain. And then you head into mid-cycle where the economy is kind of working at potential, but there's some excess that's getting in there. Things are kind of choppy. And then you enter in the late cycle phase when the economy has kind of worked off its excess. You get the inflation as a result of above trend economic growth. And that's where a lot of inflation protection and low volatility assets become more favorable. And obviously, everyone's scary point, the recession that
Mm-hmm.
occurs, it's typically the shortest part of the business cycle and where most of the opportunities are realized. However, recessions come in different flavors, right? You can have a financial crisis like what we saw in '08, or you can have a minute sort of profit recession where it's just a valuation reset. So we tend to think of these phases in terms of right sizing your investment playbook.
So before I bring Joseph back into the discussion, one last question directly to you, and then I'll let him follow up. Where are we, do you think, in the cycle? Because this time is different. I mean, it's just crazy. Dominic?
Oh, for me, so I tend to see it in terms of like the economic cycle versus the market cycle, right? So I rely on a lot of leading economic indicators and surprises, right? So you have inflation surprise and an economic surprise. So I would say looking at leading economic indicators, we're actually at a trough since 2022 when a lot of the recessionary environments were being priced in, and we're kind of exiting out of that scenario. So that's where I see the leading economy in. The coincident economy, which is as a result of, right? So inflation kind of heading down, you're kind of late cycle environment. Now, the market has actually been pricing in again a recessionary environment where again a lot of opportunities are being realized, valuations have now come back down to a normalized state. So that's kind of where I see it. The market and now kind of coinciding with the economy where it's an actually a larger opportunity set.
Joseph, what do you think?
Yeah,
How do you?
yeah, when the recession, I mean, I guess we had a 2 month recession in 2020.
Yeah.
They've been talking about recession the last 3 years. We haven't seen the recession yet. Maybe this time. What do you think, Dominic? Are we actually going to? They've been the economists predicting recession now for the last 3 years, which hasn't occurred. Now we did have
Mhm.
1 quarter negative growth. Do you expect that we're gonna see a second quarter of negative growth? Doesn't look like it to me from this point.
Yeah, it doesn't really seem like it. I think we had like a semi-technical recession in 2022. Um, give and take, we might, right? Profits have been pretty exuberant. There was a lot of froth heading into this market. So, even if we do, it'll be realized, but very short term, right? I don't think we'll enter in a crisis of sorts. It's actually very nice if we have a nice recession because that lowers inflation back down to normal standards. As long as there's not widespread pain, it's a nice reset. And again, the conference board, once they come out with their recessionary sort of place mark, it'll be well after the fact. They wait for a lot of confirmation. So the market will actually be moving well ahead of that. And that's where you got to participate.
Dominic, what is it that, why can't we take all of this data? We have 50 years plus of data that we could
Mhm.
load into ChatGPT, pick your, 4.0 or even 5 is about to come out, or into Gemini. We could load in the economic cycles and history that we know. Why can't we just load that in and say to the AI, okay, what should I do in order to get this return? Or can we do that, and is that happening?
Yeah, that is scary, right? So you wouldn't want to trust that because it's incorporating all the historical data, but not the real-time data, right? And not the expectations that might come about. And of course, investing is highly personal, right? So it's based on whatever positioning or expected return you have, and you're adapting that to the current environment. That's not something that you can be able to program, expert or sort of accurately, right? So you always have to take into consideration the current environment and the different payments that are at work. And that's why we take a more sort of measured approach, right? Something more binary, where we're actually incorporating real-time market data to understand, okay, well, we don't have to forecast where the economy is heading. All we need to do is identify where the trend is and also calculate momentum on top of that and sort of position accordingly. I think that what you'll realize is it tends to rhyme with a particular cycle very well instead of having to sort of guess where things are headed. A little bit of stagflation, right? So I think
Right.
that has been the norm now, right? People have kind of gotten accustomed to that, where you have slower economic growth than normal and a sort of peak or elevated inflation levels, right? It's coming down, but it's coming down at a slower pace than what the Fed would be more comfortable with. That's stagflation. What that does is it actually complicates the correlations between bonds and equities, right? Because bonds, not so good of a buffer, equities, a little bit more volatile. So where do you go, right? It's hard to diversify in a stagflationary environment. You're either going to need one or the other: high inflation, high growth, low growth, but both at the same time, not so fun for an investor.
Do you think we'll get the rate cut in June? I personally feel that the Fed was late on the way up, and they're
Mm.
probably going to be late on the way down. So, do you think
Mhm.
we're going to get a cut in June?
Perhaps, yeah. I mean, the 2-year yield has now, ventured below the Fed funds rate. That's typically a precursor for a rate cut regime. So I do think we're going to get that. It's just not going at the same pace as what the market would expect, given all of these factors like tariff uncertainties and elevated inflation still, and economic growth is still positive, right? So I think all of those factors come into play, but a lower rate cut regime is definitely going forward.
The one thing that hasn't changed is the market itself, right? The market's driven by the irrefutable law of supply and demand at the end of the day. It's that simple, right? More buyers than sellers, stock prices will rise. More sellers than buyers, they'll go down. Equal buyers and sellers, they'll stay the same. That hasn't changed. The fear and greed and the emotions of the market basically is the same as it was 50 years ago.
But what we can rely on best is we know that the Fed does not make preemptive moves. They tend to lag, right? So similar to COVID, inflation was transient until it was realized, and then you see the Fed rate hikes, right? Now it's kind of like the tariff uncertainty is there until we realize the actual effect of it, and then you see the Fed act. So I think a lot more of the uncertainty just has to be kind of put away. The tariff environment is still kind of up in the air. Economic growth and inflation, those numbers are coming out, but they're not, we don't have a solidified view of where we are in the cycle. So yeah, I mean, we'll see what happens in June, but I think after the effect, then we'll see more of the data be realized.
Dominic, what happens to investors in the United States if the position of the United States as the place to park your money, whether it's in fixed income or in capital and equities, what happens if that has been changed by the policies of the current administration?
I don't think it'll change too much. I think that what happens is, there is a huge valuation discount between the US and the rest of the world. That's pretty attractive to allocate some capital to an opportunistic bucket that would take advantage of the international markets. The US is still very much outperforming over the long term. We have a robust capital market, and that should be the core of your domestic portfolio for sure. You create these little tactical buckets outside of that. I think that's just kind of what's going to happen. We look at long-term trend shift on the 10-year yield. 3.5 is typically the breakout new base, right? So again, you're coming off of an environment where you had a nice living yield of about like 7 to 8%, and now it's kind of low, but higher than the low rate environment that we saw. And obviously, keeping rates low for too long creates a lot of froth and exuberance, right? So you don't want that. A higher than normal, right, rate is actually pretty good for the market. It forces you to focus more on fundamentals, and it kind of keeps the market in balance. So I do expect rates to remain in a higher than normal range of about 3 to 5%. And we'll see where that goes.
The other thing is that when we were going through this massive volatility in early April, investors' sentiment was the lowest ever recorded, even lower than 2008, which is pretty amazing, right? And look where we are now.
So, Joseph,
Agreed. Yeah.
let me ask Joseph this question, and then Dominic, you can jump in because you have that kind of global visionary look of this. I keep hearing stories about outflows. We talked about outflows from mutual funds. I'm talking about outflows from equities in the United States to Europe and to other parts of the globe, where for the last 10 years it's been coming this way. Now I realize that it's supposed to do that, but why should I not, as an investor who is very heavily based in the U.S., be not afraid of that?
Not afraid of outflows. Money moving internationally. Yeah, the international markets have had a better year than the U.S. market. But my feeling is that we always weather these storms and get through them. And I look at a long-term chart from 1970, right? I mean, and we've had some major, like in 1974, the market was cut in half. I was in the business at that time. I'm not sure how I survived that downturn. But if you took a $10,000 investment in 1970, what do you think it would be worth at the end of 2024? Any guess?
I'd say $2 million.
You're right. It's like $2.3 million, right? So we do weather these storms. I mean, I don't think I don't think the news of tariff is going to turn a good company into a bad company, in my view. So if you believe in America, my feeling is that you'll continue to think about where you want to put your money for the long term.
Dominic?
I agree. I think, it's funny at Global X ETFs where I used to work, we had this term of, international markets, you rent, you don't own. They have these tactical areas of outperformance and underperformance, but over the long term, US markets do continue to dominate, right? That relative ratio is still in a very sharp uptrend. So you don't want to cannibalize your portfolio with all these other different things, right? The important thing is to know, right, your US allocation at the very least should be balanced with some global diversification, right? But do it at an appropriate size. I think that's the expertise of portfolio management. It's like a risk budgeting approach, right? So that's kind of what we've been doing. We've, equalized our exposure to US equities. We've, reduced the long-standing overweight, added some emerging markets and European, but at the same time, we're not getting rid of our US and putting it as extreme underweight. That would be foolish, right? Because we are looking for long-term gains with some opportunistic allocations here and there. So I think that's what investors should do. It's a wake-up call to not just have a US-dominated portfolio, add some diversification on top of that, and just remain opportunistic when the opportunities arise. And also know that flows are backward-looking. They tend to be a contrarian indicator. After the money has moved, they take profit when it becomes overvalued or too stretched. Investors should, move accordingly.
Dominic, final thought from you?
Yeah, agreed. I think the topic of this show is important, right? The evolution of markets. I was a benefactor of that. I think also, technology lowers costs, is increased accessibility, but it also requires the onus is on these providers and fund managers to be disciplined and do what's right for the end investor. Discipline is key. Knowledge is also empowering.
And very quickly, where can people find Dantes Outlook? How do they get more from you?
Yeah, thank you. DantesOutlook.com is our website. And then on LinkedIn, if you just search Dantes Outlook, we have a page there where we actively put together research and share it.